Uh, yeah, good evening to each and everyone present here. In our previous session, we had discussed about the core emotions in trading. In this, we have discussed about the core emotions like fear, greed, overconfidence, hesitation, hope, and regret. We explored what they are, their impact, and how to manage them effectively. Today, we will dive into psychological biases. And the first psychological bias is overconfidence bias, which is one of the most common traps traders fell into. So, what is this overconfidence bias? This overconfidence bias will happen when traders overestimate their ability to predict market movements or their skill in making. And this overconfidence bias will happen when traders overestimate their ability to predict market movements or skill in making profitable trades. Like, for example, a trader who had a streak of winning trades might believe they have figured out the market and that their strategy will always work. This false sense of mastery can lead them to take on bigger risks, often ignoring the reality of market unpredictability. And the impact of overconfidence bias is it leads us to take excessive risk trading. Like traders may take on positions that are too large or trade highly volatile assets thinking they can handle it. And it can lead us to overtrading. Confidence in abilities might push us to place more trades than necessary, increasing transaction cost and exposing ourselves to more risk and ignoring market signals. Overconfident traders may overlook important indicators or warnings because they believe their analysis is superior. And due to this, uh, we will over invest in one stock or one sector, ignoring the need for a balanced portfolio. And how to manage this overconfidence bias? Keep track of performance. Like we need to keep a detailed trading journal to record our trades, reasons for entering, exiting, and outcomes. We need to analyze both wins and losses to understand if success is due to the skill or favorable conditions. And the most importantly, like we need to have a journal, like for every stock, if we are exiting, why are we exiting? If we are entering, why are we entering? And what are the lessons learned from the trade? And in that way, definitely we will master investment one day. And we need to stay humble after wins. Like if we win too much, if we winning streaks can feel empowering, but we need to always be approached with caution. And we need to set risk limits. Like we need to always define our risk before entering a trade. For example, we need to use stop loss orders and never risk more than a set percentage of our capital on a single trade. So this overconfidence bias, in the word itself, it is there, like overconfidence means when traders overestimate, okay, I had entered a trade one time, I had entered a trade two times, it had succeed. So definitely for the third time too, it will succeed. It will happen. It will happen at the time of earnings. Like let's say, like for example, Netflix. Let's say any big company earnings is coming. So okay, Wall Street is expecting a very huge revenue, a very huge EPS. So just based on that, okay, uh, we will go with overconfidence. Like okay, it will rise or it will fall, but there will be so much calculation behind that. And there's anchoring bias. And this bias can significantly impact our decision making, and it lead to missed opportunities or losses if not properly addressed. And what is this anchoring bias? This anchoring bias occurs when traders rely too heavily on the first piece of information they receive and base all subsequent decisions around it, even if new data suggests otherwise. Like, for example, a trader sees a stock trading at $100 and considers it fair value. Even if the stock drops to 80 due to bad earnings or rises to $120 because of strong demand, the trader might still cling to that $100 position as the reference point. So this prevents them from adjusting the decisions based on updated market realities. Like just for the practical example, a few days back, there was some short report came on ASPI company. So just because of that short report, many traders had invested in our ThinkSabio itself. But after, after we have came to know that okay, the stock that short report is not reliable. That short report is somewhat seems to be not genuine. So so it had starting failing so much, and many people had faced loss on that day. So immediately after the market close, again the company had issued a statement about the short report. Again after that, it had started raising for some extent, but at that time it became too late. So this is the practical example of anchoring bias. Okay, just like uh, for the by relying too much on the first piece of information we had entered, whereas the after the market had been whereas after the updation, the market updated had something. We had not adjusted to the market with the time. So what is the impact of anchoring bias? Inflexibility to new information. It can prevent trades from adopting to new information. Like traders, we may ignore fresh data or market conditions because we are stuck on our initial analysis. Like for example, if a stock falls 30%, but we we we, we fix ourselves to the original price, so we might refuse to sell, thinking it will rebound, ignoring signs of further decline. So missed opportunities and anchoring bias, it will lead us to miss profitable opportunities. Like for instance, if we anchored to a low price, we not we might not buy a stock that has risen slightly, even if it still has growth potential. Like for example, uh, many of us will invest, like okay, many of us, let's say for example, we may invest in sound, like for a sound company, we may invest at, let's say for example, $13, and we may sell at $13.50. So there will be some, we may invest, okay, for the quick play, so we miss such quick plays due to this anchoring bias and inefficient risk management. By relying on information, we we need to adjust our stop loss, profit targets, and eventually it will lead us to more and more risk. And market conditions, I mean, it leads to this anchoring bias leads us to trade emotionally. I mean, as we struggle to let go of our initial assumptions or expectations. And how to manage this anchoring bias? Continuously updated analysis. Like, we need to regularly ask ourselves if the information which I am using is still valid. For instance, if I am holding onto a stock based on its past performance, we need to assess whether current trends still support that decision. Consider new data. I mean, instead of relying on a single price or piece of information, we need to use multiple indicators like technical indicators, news, market sentiment to take decisions. And we need to avoid being fixated on past information. Like, we need to establish criteria for buying and selling that are based on data but not on emotion. Like, for example, if I decide to sell if a stock drops 10% below our entry point, regardless of its previous high, we need to uh, we need to we we need to adopt that decision. We need to stick to that decision, but not to act uh, emotionally. And next we have confirmation bias. So what is this confirmation bias? This confirmation bias occurs when traders intentionally or unintentionally seek out information that supports their pre-existing beliefs or expectations while ignoring evidence that contracts them. For example, a trader buys a stock believing it will go up. They actively look for news or analysis that supports this belief while ignoring negative reports or market signals indicating the stock might fall. This creates a tunnel vision effect where decisions are based on selective evidence rather than an objective view of the market. So just like the example, I mean, in group, we discuss about some stocks. Uh, I mean, uh, previous some 1 year back, 2 years back, I mean, okay, we invest into certain stocks just because there was a major institutions on that stock, there was a major hedge funds on that stock, and the institution counts or the performance was increasing based on the previous quarter. The quarterly performance was good, but we will stop to we will stop seeing on the negative side of the stock. Okay, let's say for example, the Nvidia institution had invested into RX company. Okay, just because okay, Nvidia had invested on that company. So if such big institution had invested into that company, so they may have thought something, they may have some ideas, it may rise further. So just because of that information, if we invest, so I mean, there is no guarantee that we may I mean, there is no guarantee that we may get into profit. Just like Berkshire Hathaway and Berkshire, he invested into Siri company, but still that company eventually had not generated any profit till now. So what is the impact of this confirmation bias? And this confirmation bias leads to one-sided analysis. I mean, instead of considering all available data, traders focus on information that aligns with their preconceived notions. For example, we might disregard a company's declining earnings because we are convinced its stock price will rise based on past performance and reinforcing wrong decisions. I mean, when we only see what we want to see, we might stick to poor trades longer than necessary. This can lead to bigger losses or mislead opportunities to correct a mistake. Overconfidence in trades. We selectively focus on supportive information, which can create a false sense of security. Overconfidence often leads to excessive risk taking or failure to set stop losses, increasing vulnerability to market volatility. And we missed learning opportunities due to this confirmation bias. Like we ignore contradictory evidence that prevents us from learning from our previous mistakes, leading to repetitive errors in future. And how to manage this confirmation bias? Actively seek out opposing viewpoints. I mean, we need to actively look for information or opinions that contradict our expectations. For example, if I believe a stock will rise, we need to read bearish reports or analysis to gain a balanced perspective. And we need to evaluate data objectively before making decisions. I mean, we need to avoid making decisions based on emotion or attachment to a belief. We need to use objective metrics like earnings reports, technical indicators, or market trends to guide our trades. I mean, we need to diversify our source of information. I mean, we need to avoid relying on a single news outlet, analyst, or report. We need to use multiple sources to get a broader view of the market. We need to consider the opposite scenario for every trade. Like if I am buying a stock expecting it to rise, we need to ask ourselves what would happen if it fell and why. Based on balanced analysis, we decide to limit our exposure or avoid the trade altogether. And next, herding, following the crowd. And what is this herding? This herding occurs when traders follow the actions of the majority or the crowd without conducting our own analysis or due diligence. Instead of relying on independent research, we are influenced by what others are doing, believing that the crowd must be correct. This behavior is often leads to FOMO, in the sense fear of missing out, or a lack of confidence in personal judgment. For example, if a stock price is rapidly rising, many traders may jump in simply because others are buying it, even if they don't understand why. Similarly, during a market downturn, traders may panic sell just because the others are doing so, ignoring the stock's actual long-term potential. And what is the impact of herding in trading? Poor can lead to poor decisions. I mean, following the crowd often leads to impulsive actions based on sentiment rather than logic or analysis. I mean, traders may buy at market peaks or sell at market bottoms, locking in losses. And it will eventually increase the market volatility. Like hedging can amplify market swings. For instance, a wave of panic selling can drive prices lower than justified, while mass buying can inflate prices beyond their true value. And due to this, there will be exposure of speculative bubbles. Like herding is a key driver behind speculative bubbles, where asset prices skyrocket based on hype rather than fundamentals. When the bubble bursts, hedging participants often suffer significant losses. And when the crowd is driven by fear or euphoria. So, heading often stems from emotional extremes in the market. So here euphoria means buying into a rapidly rising stock because everyone else is doing it. Fear means selling during a market dip due to panic and herd mentality. So how to manage this herding bias? We need to rely on individual research, base decisions on thorough analysis of company fundamentals, market trends, and technical indicators, not just popular sentiment. Like we need to always ask, why is this stock trending? Does the data support its movement? Maintain a clear strategy. We need to define our trading goals, risk tolerance, and strategy in advance. We need to avoid deviating from our plan based on crowd behavior and avoid making decisions based on popular sentiment alone. Like here, we need to evaluate risk versus reward. Before acting on popular sentiment, we need to access whether the trade aligns with our risk reward criteria. We need to avoid buying into hype without understanding the downside. And we need to avoid emotional trading. Emotional extremes like fear and or excitement are common drivers of hurting. We need to practice patience and rationality even when market movements are dramatic. And finally, we need to learn from market history. Many market bubbles and crashes, like the dot-com bubble, cryptocurrency booms, were fueled by herding behavior. We need to study past events, which can help us to identify signs of irrational crowd behavior. So the best example of this herding is, a few months back, many people had invested into GameStop stock just because some roaring kitty had invested in that. There is no technical analysis, no fundamental analysis. So, in early 2021, GameStop's stock price surged due to a coordinated effort by retailer traders on social media platforms. Many traders joined the frenzy simply because the stock was trending without understanding the fundamentals or risks. And what is the outcome? Some early participants had profited. Latecomers who bought at inflated prices suffered heavy losses when the stock's value fall. And this highlights how hurting can create short-term excitement, but often leads to long-term losses for those who act without analysis. And loss aversion, fear of losing over gains. And what is this loss aversion? Loss aversion is a cognitive bias where the pain of losing money is psychologically more significant than the pleasure of gaining an equivalent amount. For example, when we lose $100, we feel much worse than the joy of earning $100. And this loss aversion can affect traders to hold on to losing trades for too long, hoping they will recover, avoid taking risks, even if the potential reward is high. So this bias stems from human nature and psychology, where avoiding losses was crucial for survival. However, in trading, this fear can cloud judgment and hinder success. So here, in loss aversion, what will happen is our main priority will be we need to avoid losses. That's the our main priority. Okay, we never intend, we never think of uh, making the profit. Let's say, for example, even if I had invested in the stock and the stock started rising and it was rising, but still we sell that stock because we may think, okay, it may fell after, okay, it may fell now, it may fell now. If it fell, I may not regain my profit. I may again go into loss. This often happens in options, like due to the time decay, due to the expiry, the premium will decrease. So what will happen is, okay, let's say if I invest in options on today, and the expiry will be on, let's say, after 1 day or after 2 days, the expiry. So it will started decreasing today. It will start to decrease. Okay, I will get into some loss. I will get into some loss, a certain loss. But after a certain loss, the options will start rising. I mean, it will rise further and further, further and further, and because of the time decay and expiry, okay. I mean, even though I get somewhat less profit, okay, I will get into break even, or I will get into some profit. Then immediately we will sell that uh, trade, because in that mindset, what our mindset will be, okay, we need to avoid loss aversion. Okay, at least we had get into break even. At least we had got some profit. Okay, it is enough. It seems to be very risky. Let's get exit. But what eventually happen is it will rise again and again, again and again. Uh, so this loss aversion, in this loss aversion, traders' primary focus will be on avoiding losses but not on making profits. And what is the impact of loss aversion in trading? Can lead to holding on to losing positions too long or overly cautious. So here we may refuse to sell a losing stock, thinking it will recover eventually. This behavior can tie up capital that could be used for better opportunities. I mean, fear of potential losses may prevent us from entering high reward trades. Overcautiousness can result in missed opportunities for growth and missing opportunities for growth. Like, loss aversion amplifies emotions like fear and regret, leading to irrational decisions. I mean, traders might exit profitable trades too early to lock in gains rather than following a well planned strategy. And this bias distorts risk reward perception. I mean, traders may focus too much on the risk of losing and ignoring the potential reward. And how to manage this loss aversion? Set stop loss orders. I mean, predefine the maximum loss I am willing to tolerate for each trade. Automatic stop loss orders help take emotion out of the decision making process. Accept small losses as part of the trading process. I mean, we need to treat small losses as part of the trading process, not as failures. Remember, even the best traders face losses. It's the cost of participating in the market. And we need to focus on long-term goals. Avoid fixating on individual losses. Look at the bigger picture and evaluate your performance over multiple trades. A series of small losses doesn't matter if your overall strategy is profitable. I mean, before entering a trade, we need to calculate potential reward compared to the risk. Aim for at least a 2:1 reward to risk ratio. This ensures that even if some trades result in losses, the overall outcome will be profitable. Okay, instead of seeing losses as a negative view them as lessons. Ask ourselves what went wrong, what can I do differently next time. Like, so here in this loss aversion, let's say for example, we had bought a stock at $100, and that $100 stock had dropped to $70. Instead of selling, instead of selling and accepting the $30 loss, we hold on to it thinking it will recover soon. Over time, the stock drops further to $50, increasing our losses. Meanwhile, we miss other profitable opportunities because our capital is tied up. So just by setting a stop loss at $90, we could have minimized the loss to $10 and reinvested in better opportunities, potentially recovering and growing our portfolio faster. And finally, we have recency bias. So what is this recency bias? And recency bias is the tendency to give greater weight to the most recent information, events, or outcomes while ignoring long-term patterns or historical data. Traders might assume that a recent market trend will continue indefinitely, even if it contradicts broader trends or fundamentals. This bias is rooted in human psychology. Recent events are more vivid in, in memory, making them seem more significant. For example, if a stock price has risen sharply over the past week, a trader influenced by recency bias might believe the upward trend will continue without considering past volatility or market fundamentals. Impact of ration. So here what's happening is we rely too much on recent information. Like just because, okay, let's say for example, a company had declared its quarter 3 earnings today and the earnings is good. Okay, it had, okay, due to the earnings, it had reached 10% or it had reached 20%. So now we start to believe that, okay, as the earnings is good, so it will eventually do good and we will purchase the stock after raising the 10%, after when it had already raised to some extent. So what will happen after some days? It again started falling. So here we need to analyze the broader market rather than the recent piece of information. And impact of recency bias, overreaction to short-term events. I mean, it can cause overreaction to short-term price movements. We may believe we may buy or sell based on recent price movements, ignoring the broader context. For instance, a slight dip in stock price may lead to panic selling, even if the stock is fundamentally strong, and leading to impulsive decisions. I mean, recency bias can trigger emotional decisions rather than rational data driven ones. Like uh, traders may chase trends without considering whether the price is sustainable. And we need to, I mean, due to this recency bias, we neglect long-term trends. By focusing only on recent data, traders might miss out on valuable insights from historical performance or market cycles. And this can result in missed opportunities or poorly timed trades. And when many traders fall victim to recency bias, it can amplify market volatility as everyone is reacting to the same short-term events. And how to manage this recency bias? Analyze long-term data and market fundamentals. I mean, we need to always review historical data, including price trends, volume, and market fundamentals. We need to use charts, technical indicators to gain a broader perspective before making decisions. I mean, we need to stick to a well-defined trading strategy that considers both short-term and long-term factors, and we need to avoid deviating from our plan based on recent events unless they significantly impact our analysis. Avoid making decisions based on short-term trends. We need to assess the underlying factors driving market movements such as earnings reports, economic indicators, or industry trends. And this ensures that we make decisions based on solid information rather than short-term noise. I mean, we need to recognize the emotional triggers that recency bias creates, such as FOMO or panic. And finally, we need to use the stop loss orders and position sizing to limit the impact of impulsive decisions, uh, uh, and and prevent us from overreacting to short-term volatility. So by analyzing the stocks long-term trend and underlying fundamentals, we could have avoided all these biases, um, all these biases. So, so on this session, we had discussed about psychological biases which every investor or traders feels. And when we overcome all these biases, uh, we will definitely master into investment one day. So, is anyone has any doubts?
Thank you, Arshad. Nice job. Appreciate your time and effort in putting this presentation.
Yeah.